Thanks for tuning into this show, and on this hour we are talking to the Motilal Oswal think tank on their monthly note, which is the Alpha Strategist. And having followed their note and spoken to them for the last 7-8 months, they've got most of the things that they spoke about right. Now, when I get my guests on air, Ashish Shanker and Nitin Shanbhag, they will tell me that Niraj, you are being a bit unkind because we probably got all the things right. Guys, thanks so much for joining in, and great to be doing this conversation on television. Great to have both of you.
Yeah, thanks, Niraj. First of all, many congratulations. My best wishes to the channel, and I'm sure you guys will do extremely well.
Yeah.
Likewise.
Yeah, thanks so much, both of you. So let's talk about this note, right? Because we've moved up a few spaces from you guys shying away from maybe not giving an out-and-out clarion call to now this note being titled clarion call. Tell us why this title and what is the key message in this month's Alpha Strategist.
Yeah. So, Niraj, as always, I'll try and connect the dots because our editorials in the Alpha Strategies are normally a continuation of what we've been messaging throughout the year. So the big event that happened before we wrote this note were the state elections, right? And contrary to maybe expectations, BJP won more states than what was expected out of them. This basically removes the ambiguity around the 2024 elections according to us, which obviously was an event that the market was looking forward to. We believe that if 2024, nothing is a done deal, but obviously you go into 2024 elections with a lot more confidence that there will be continuity around the government. And if that's the case, if you've given all the fundamentals that we've been messaging about, if you remember years that we've been saying that sometime next year the interest rates should start coming off, and last month we gave a call on duration where we told investors in fixed income to take a long-dated view on the fixed income portfolio. Couple that with the fact that even Fed will start softening their stance sometime next year. In fact, the recent Fed meeting, they did mention that they are not looking to hike and they will look at softening rates sometime next year. Similarly, if you look at fundamentals across corporates, we've seen 3 financial years of double-digit earnings CAGR, and this will be the 4th year of double-digit earnings CAGR. So if you look at everything in entirety and the fact that now the political uncertainty is also diminished, our view is that if you take a 3 to 5 year view, this is the time to try and allocate as much as possible to equities. Of course, given the overall risk that you want to take in the portfolio from an asset allocation point of view, we believe a lot of the uncertainties are behind us. And at the same time, while domestic investors have been investing regularly, the foreign investors have still not come back very aggressively in the markets. So there will be a crowded trade to buy India, according to us, when some of these large foreign investors come back to make their allocations. So we are messaging to our clients that this is the time you get done with your allocations. I understand that there are nuances where the mid and small cap space has run up very sharply. The large cap space is a little more attractive, especially the banks and IT. My point is very simple, Niraj. If you take this entire cycle, let's say the cycle started from the bottom of the COVID, the next 3 to 5 years, according to us, is a golden cycle for India's economy and as a result Indian equities. Very similar, according to us, to the 2002 to 8 in terms of earnings and market trajectory. Given that view, right, you will always have periods where certain pockets of markets are overvalued, certain pockets of markets are undervalued. But however, you have to keep the faith. And the only way the valuations will correct is earnings grow faster. And that has happened in the mid and small cap space. By the way, the small and mid cap earnings growth last 3 years has been much higher than the large cap space. And Nitin can talk more about it. So that's the general context in which, we've given a clarion call.
Okay. And Nitin, I'll come to that mid and small cap conversation that Ashish referred to as well. But a question to you and both of you maybe. I remember a conversation that we had with somebody else spoke about how the fears of 2023 are now receding. I remember the May or June Alpha Strategist, wherein you guys had pointed out the point around the current account deficit change, build up of forex reserves, and a few other points. Some positives, some negatives. So negatives dissipating, positives building on, and it seems all of that seems to have come to a head in the last couple of months.
Absolutely. I think, just to carry forward from whatever Ashish mentioned, we are into a virtuous cycle, right? Now, first, let's look at the economy and then from a market perspective. As you rightly mentioned, our external account is good. From a forex reserves perspective, we are about $600 billion, which has good enough, import cover for us going forward. From a imports perspective, I think the oil prices being in a benign range has really helped. Our GDP, as you know, has grown by 7% over the last year or so. And if you generally see some of the macro variable trends, whether it's GST collections, whether it is, the movement or trends in some of the key sectors like auto, cement, etc., that has seen a more positive trend progressively. So, and now couple that with whatever is happening in corporate India, right? If I look at the top 500 companies, take away financials from that list, and you generally see that debt to equity ratios have compressed. From the peak highs of close to 1 times, you are now sitting at between 0.5 to 0.6 times. Your ROE profiles have progressively gone higher, and capacity utilization, has on aggregate moved from about 65% over the last 3 to 4 years to currently about 80%, and will progressively inch up further, which means there is a lot of scope for operating leverage. So, and now couple all of this with earnings growth coming together. This is why we are saying that all things progressively over the course of this year have merged into a better outlook from an India perspective.
Okay, now, and Nitin, you, okay, I'll come to the small cap point as well and earnings point in just a bit, but just since we're talking about the macro, the other important thing that now people will start talking about come 2024, and something that was a part of the October note, right? If I'm not wrong, at that point of time, you guys had spoken about the India's bond inclusion and what a pivot that would mean for flows and the depth of the bond market as well, building out. Does in some sense that plus earnings growth plus other macro worries dissipating and the political continuity, are all of these put together the reason for you being so confident, guys, of asking investors to allocate large sums of money into equities at the current valuations?
Absolutely. I mean, you're bang on. And one of the reasons that we continue to mention about interest rates was post the JP Morgan index inclusion, right? And that call has already started to work out. You've seen where your 10-year yields were in India, and progressively they've been sliding downwards. What our prognosis really was that, cost of capital in India has peaked out, and that should again progressively start trending lower. Which in a sense is likely to help margins in certain counters. But then again, what we are trying to say is that, the cushion is led by a very strong trend of earnings growth. So yeah, all of this coming together, but that as a bedrock of earnings coming together is really the reason why we are. And also, Niraj, let me just nuance this a bit, because it's not that we are not conscious about valuations, right? If you look at the Nifty and the large cap, I think the valuations are pretty much close to long-term averages, with a far higher visibility of earnings growth in the next 3 years. So there, I don't think anybody is doubting the call. I think where people are getting a little caught up is the sharp rally that has happened in mid and small caps. And you've seen many stocks zoom 3x, 4x. I think some of the smaller stocks have even gone up 8 to 10x. So whilst Look, there may be certain individual stocks where the fundamentals may not be that strong and there may be some bit of froth, and which is the case in every bull market. But largely, a lot of the stocks have got re-rated on the back of very strong earnings growth and very strong visibility in the future, right? I mean, you're seeing 40% kind of CAGR on the index itself in the last 3 years from an earnings point of view. So which means that even if you're expensive, you're 1 year away from being reasonable in terms of valuation at the same kind of earnings figure. Now, the other nuance, Neeraj, one has to keep in mind is that the last 3 years, the returns have been extremely strong. Now, we are not batting for the same kind of returns in the next 3 to 5 years. All I'm trying to say is that even if you get, let's say, 15% CAGR in the next 3 to 4 years, or let's say 12 to 15% CAGR on a mixed portfolio, right? That return is coming with a very high degree of visibility and conviction.
Got it. So you're paying for that conviction and you're paying for that visibility, and sometimes you got to do that. And guys, because we have limited time, at least on this episode, sadly, I want to focus on the equity part and not the other parts, because you are also making that clarion call around equities. And what I get from the slide that I'm looking at, which is slide number 17, if I'm not wrong in the presentation, that for new investors, you are saying, so you're making this point that as per the sentiment indicator, large caps are in the fair zone, but you're giving the call that for new investors, they should invest 100% lump sum in multi-cap strategies and select mid and small cap strategies. You must be amongst the few people currently who are saying go out and buy into mid caps and small caps. So Ashish, you started off that answer with that, and you asked Nitin to kind of bring about that point about numbers as well, but just take a moment, Ashish, and tell us why this confidence at the broader end of the spectrum, when you yourself are saying that it's large caps which are in the fair zone.
Yeah, so large caps being in the fair zone is very, very clear. I mean, if you look at the P ratio for the Nifty, right, it's closer to 18, and depending on how forward you think, like now people will start looking at FY25 numbers, and if you take those numbers, you're below 18 times valuation. And earnings growth has been, this will be the 4th year, like I said, of double-digit earnings growth on the Nifty itself. So from a valuation point of view, from a quality point of view, I mean, your ROEs have also inched up. And the best part, Neeraj, is that it's not inched up in pockets, or the earnings growth is not coming in select pockets. It is reasonably broad-based, whether it is PSUs, whether it is banks, whether it is power generating companies, whether it is the capex-related sectors. It is a very, very broad-based kind of recovery that we have seen post-COVID. Now, coming to the mid and small cap, this entire virtuous cycle that Nitin was talking about, right? What is this virtuous cycle? Essentially, all pockets of the economy have deleveraged and consolidated. See, post-COVID, what has happened is that a lot of these unorganized players, smaller players, actually went out of business or got acquired, and across industries, if you see, there are 3 or 4 large operating names which are consolidating the market. Now, what is happening for these people is that ROEs is becoming better, earnings growth visibility is extremely strong. Even sectors which got impacted during COVID, like travel, hospitality, those sectors have come back very, very strongly. So a lot of the large earnings growth, Neeraj, is happening outside the Nifty. And that is where you are seeing small and mid-cap companies' earnings doing extremely well. The second point I wanted to make, and this is a call we had given almost 2 years back, that the investment part of the economy, whether it is cap goods, whether it is engineering, whether it is ancillary units to the construction industry, all of these industries will probably lead the way in this cycle. And discretionary consumption will do well, but it will take a backseat in terms of returns, because a lot of these sectors have been not neglected, they've languished for almost a decade, and the valuations have got beaten down. So here you have double engine, you have re-rating engine and the earnings growth engine. So some bit of the re-rating is done, but the earnings growth visibility is extremely strong. So that's our view. I'm just going to add a little bit of color in terms of numbers to what
Yes, very important.
Our institutional equities desk actively tracks a list of about 250 odd companies, right? Now, if you look at the trend from FY17 onwards, FY17, the profit pool for all these companies was about 4 lakh crores. Okay. By FY20, it had moved to just 4.2 lakh crores. So nothing happened during that time period for almost 3 years. Now by end of FY24, that entire profit pool is likely to be closer to 11 lakh crores, right? So which is up more than 2.5 times. And we are talking about a broad, set of companies, almost 250, which will include large, mid and small. So what we are really trying to say, to answer your question in terms of, have multi-cap oriented strategies as a bias to the portfolio, is saying that let the, good quality managers decide which pockets they want to enter into. As Ashish rightly mentioned, the large cap looks from a valuation perspective relatively more attractive valued as regards to mid and small cap. But there are pockets of opportunity in good quality companies where you can still make superior returns over the long term.
Okay, and and viewers, in some bit, I think the size of the small and the mid caps have also gone up. I mean, there's a note that I was reading which said that the small cap upper threshold has now approached the $3 billion mark in India, and that's probably one of the unique things that is happening in the Indian landscape. But fabulous point, gentlemen. Stay on. We need to slip into a very quick break. On the other side of the break, now that we've established that the call from Ashish and Nitin and Motilal Oswal Wealth is a clarion call for equities and not shying away from calling, giving a positive call on mid caps and small caps as well. We come back from the break and try and do a little bit of nuance into that call. If we can add a little bit of other asset classes, we'll try and do that as well, time permitting. Stay tuned. Back on NDTV Profit in a conversation with Ashish Shanker and Nitin Shanbhag on their monthly publication, which is the Alpha Strategist, which they talk with us every single month. Now, we've established that they are constructive on equity markets at large from a 5-year perspective, and even on the mid cap and the small cap end of the market. We figured out the numbers as well and the possibility of that growing. I would love to understand what is the sentiment now, and then we'll of course talk about some numbers on the other asset classes too. Now, Ashish, I know you talk to arguably the widest HNI network in the country. I'm just trying to understand, one, this messaging when you've given them, are people sanguine about putting in money? Because when I talk to HNI investors or fund investors on the channel, they are becoming very, very choosy and selective, and some are becoming very skeptical as well. So I want to understand, you speak to a much wider network. What's the feedback currently that you are getting when you propose what you are saying in your messaging to them?
Yeah, so there are two ways to look at this, Niraj. One, if you look at the country as a whole, and we run a very large broking business as well. So that change in trajectory which happened post-COVID, I mean, before COVID you had 30 million demat accounts, today you have close to 120 million demat accounts, and every month we are adding a significant amount of accounts which is contributing to greater participation in equities. So the confidence in Indian equities continues to improve, march on. You are seeing better participation from households, and that is also reflected in the SIP flows. The gross SIP flows are now closer to 17,000-18,000 crores, right? So the structural story is very, very clear that households are allocating more towards equities. Now let's come to the sophisticated part of the market, or what you call the smart investors or HNIs or ultra HNIs, right? Now these investors are more about asset allocation, right? They keep allocating between equities, alternates, or for that matter gold, or maybe international investing. Now these are the investors who track markets very closely. They have access to wealth managers like ours. They have access to a lot of data. So in certain pockets, or in a lot of pockets, there is a little bit of apprehension about mid and small caps because markets have done extremely well, a lot of stocks have gone up, and remember there is always an anchoring bias, whenever you keep looking at portfolios, and trust me, we haven't seen a bull market, a sustained bull market in India for quite some time. I think if you ask anybody, when was the last time you felt a bull market, and they will say that it was 2007-8. So there is still that apprehension, and that is what makes me confident, Neeraj, that we still have a long way to go. This is how disbelief, you have markets when people are extremely negative, and then that negativity turns into some bit of disbelief, and then it turns to a little bit of positivity, and then it turns to exuberance. So while there are certain pockets of the market where there is exuberance, but I still don't believe that you have a large-scale exuberance in terms of sentiment. So I still feel we have some way to go in this market. There could be corrections, interim corrections, which can happen anytime.
Yeah, but because it's difficult to time that, Nitin, just one quick pocket on this, and then we'll get in the fixed income piece as well before we wrap up the show. But the common refrain to that small cap argument is that yes, there are pockets of growth within there, but as an aggregate, the index, one that has gained so much, but it's trading at multiples which are extremely high, 30 times or whatever your numbers might be. Now, that is not exactly fair value. That is stretched by any stretch of imagination, right? So, could there be so there might be growth over 5 years, but in the interim, could we see a correction, or will earnings make up for it?
So, there is bound to be some correction around the corner, right? Even in the best of bull market that you saw between 2003 to 2007, you did have phases where the entire broader market fell anywhere between 25 to 30%, and this was still in the bull phase. So, corrections can happen at any point of time. But, let me give you some, numbers to back up the earnings argument. Ever since 21, large caps have grown by about 22% in terms of compounding earnings, which I'm talking about Nifty 50. The mid cap earnings have compounded by about 30-odd%, and the small cap index has compounded at about 40-odd%. So it just tells you that at a broader market level, the smaller cap companies have compounded at a much faster rate in terms of earnings growth. Also, if you look at the ROE profile, which basically signals quality or efficiency amongst these companies, compare all these indices ROEs where they stand today versus their last 10-year averages, the ROEs have progressively moved much, much higher. Now, as companies have gotten more efficient, as they start producing more cash flow from operations, you will find those indices trading at a premium, right? So the argument is well made that relative to large caps, mid and small caps are trading at a definitive premium. But at some stage, one has to take cognizance of the underlying earnings growth. And yes, there has to be some kind of time correction or moderation in terms of valuations. Earnings will still need to catch up over a period of time.
Neeraj, the only point I wanted to make, which will be useful for your investors and viewers, is typically when this kind of rally happens, people try to see what is undervalued and they basically compromise on quality. The one thing you should not do in this kind of a phase is compromise on quality. Because like Buffett says, when the tide recedes, it's only then you know who's swimming naked, right? So stick to quality is the mantra. Even if the markets keep going up, don't try and move down the quality curve because something is cheaper.
Yeah, because, and that's a pertinent point, viewers, because you don't have small cap index futures in your portfolio. You've got individual stocks, you can choose quality. We have 60 seconds left. I just want to round this off with a fixed income commentary as well, because you guys have mentioned that you recommend increasing duration in the fixed income portfolio to capitalize on the softening of yields over the next 1 to 3 years. Quick call, either of you on this piece.
Yeah, so we continue to maintain bias towards long duration, which means that we are asking people to invest into 10-year or higher maturity through a plain vanilla GSEC fund or a GSEC security, right? Now, you can't get better than that because there is hardly any credit risk to speak of, and you will get a very healthy coupon today, which is in excess of 7% plus. Plus, whenever yields actually trend lower, you're likely to see capital appreciation, right? So, to our minds, you can get very close to double-digit or higher returns over a period of the next, let's say, 18 to 24 months, even if you stick to a plain vanilla GSEC fund. And apart from that, from a satellite position within fixed income portfolios, you can look at REITs as a good asset class, InvITs, and some of these select private credit strategies.
REITs are very attractive, Neeraj, right now.
Mm-hmm. Okay, you want to just quick 30 seconds, Ashish? Why do you say that? Quick 30 seconds before we wrap up.
REITs derated after the budget because of some tax announcement, and then that clarity came in from the finance minister. After that, they have not re-rated. So the payouts, the total return, according to me, REITs, you will get in excess of 12%. That is the payout plus escalation in rentals and the cap compression that will happen. Because they are the longest duration asset you can buy, other than GSEC. So I'm we are very positive on REITs. I mean, it's a must-have in every portfolio.
Thank you so much for that. Well, there are multiple nuggets that have come out. While we thought there will be only pure equity conversation, but multiple nuggets that have come out. But a clarion call and a one which is different than what I'm hearing from the rest of the street. Thank you so much, gentlemen, for bringing us to our channel and our platforms, and look forward to talking to you in the month of January as well.
Thanks, Niraj. Pleasure as always.
Thank you so much.
Thank you, and viewers, thanks for tuning in.